Welcome to the webinar on demystifying the FBAR. This is Mike DeBlis, and it's my pleasure to have you with me here in this 7-part series on demystifying the FBAR. Here you can see how I've broken down the modules. There are a total of 7. We are going to jump into Module 1, which is deconstructing the FBAR rule. And all I mean by deconstructing the FBAR rule is that we are going to break it down into its individual elements or pieces and discuss what each part means. Because each part has a very special definition, and it's important that we thoroughly understand what that definition is so that we can apply the rule properly. In Module 2, we'll continue deconstructing the FBAR rule. In Module 3, I'll answer the most commonly asked questions about the FBAR. In Module 4, we'll cover willfulness. In Module 5, I'll take you beyond the FBAR, and we'll talk about other international reporting forms that are not as common as the FBAR, but are just as important. In Module 6, we will discuss this whole concept of certifying non-willfulness for purposes of the streamlined procedures. And in Module 7, I'll give you some practical and sound advice for navigating the choppy seas of IRS voluntary disclosure and streamlined. Let's jump into a story to kickstart this webinar. Let me take you back to 1997, the year that Dustin Hoffman won the Lifetime Achievement Award at the Golden Globes. For those of you who don't know, I am a huge fan of Dustin Hoffman's, and I absolutely adored his performance in Rain Man. He is one of my favorite actors. During his acceptance speech, he thanked everyone who helped him during his career and told a story that has a great deal of relevance to this topic. The story went something like this. When I was doing a promotional tour for The Graduate, I found myself flipping the dials in my hotel room one night. I came upon an interview of the great Russian-American composer Igor Stravinsky. It caught my eye, and after listening to it for a few minutes, I became spellbounded. The interviewer asked Stravinsky, "Sir, what is the best moment for you as a composer? Is it when you have finished a newly completed work?" Stravinsky pondered the question and answered, No, it's not then. Then, is it when your agent informs you that the piece will be performed at one of the great concert halls of the world? No, it's not then either. Then, is it on opening night at Carnegie Hall or the Kennedy Center when the last note has been played and the audience erupts into a standing ovation? Is that the best moment? No, not then either. Well, sir, the interviewer asked, what is the greatest moment for you? Well, I will tell you. When I'm working on my piano in a composition, looking for the melodic phrase that will carry the moment forward, I will be sitting at the piano going, be-bum, be-bum, be-bum. This goes on for hours, days, sometimes even weeks. Be-bum, be-bum, be-bum. Then, miraculously, it happens. I find the note. That, for me, is the moment. Dustin Hoffman now gives the audience the moral of the story. My fellow actors, for me, the moment is not when I get cast in a major role in a blockbuster movie. The moment is not when I stand before you accepting a Lifetime Achievement Award or even an Oscar. But when I am doing my B-bums to find the inner soul of the person I'm portraying, whether it be Benjamin in The Graduate or Ratso Rizzo in Midnight Cowboy or Papillion, when I come upon the B-bum that makes that character work, that, for me, is the moment. And so, my fellow tax practitioners, the B-bums in our profession aren't found when we find the answer to a mind-numbing question in the U.S. tax code, as enticing as that might be, but instead when we discover a way to simplify it so that it can be understood by a layperson. That's what I'm going to attempt to do for you today with the FBAR. Here are our learning objectives for the first two modules. We're going to learn the purpose of the FBAR regulations, determine who must file the FBAR, determine the FBAR filing requirements, determine who is exempt from the FBAR filing requirements, and finally, discuss the civil and criminal penalties that may apply for not complying with the FBAR filing requirements. Ooh, a little scary there. Let's kick this off with a little bit of information on the culprit. This is the reason why we are in this position in the first place. None other than U.S. Worldwide Taxation. It is the Grinch that stole Christmas. And what I mean by U.S. Worldwide Taxation is that the U.S. taxes its citizens and residents on their worldwide income regardless of where it is earned. This small sentence has created so much complexity in the tax law and misunderstanding that it's not even funny. So let's put some meat on it, on the bones here. The U.S. stands alone as one of the only countries left in the world that still taxes its citizens and residents on their worldwide income. Now, what do I mean by taxes its citizens and residents on their worldwide income? Well, let's say that you own a business in Sri Lanka. Guess what? You have to report the profits from that business on a U.S. tax return. Let's say you work for a French company in Costa Rica. You have to report your earnings from that French company on your U.S. tax return. Very simply, U.S. taxpayers must report all of their income, domestic income as well as foreign source income. And that's what I mean when I say foreign source income. I'm specifically referring to income earned outside of the United States. So how does U.S. international double taxation rear its ugly head? Well, the typical fact pattern is when a U.S. citizen or resident derives income or holds assets in another country. Now, before we go any further with this concept, I want to make myself very clear on one point. It doesn't matter whether the U.S. citizen is living in the United States or is living in Hong Kong, China, Brazil, France, the UK. He still must pay taxes on his foreign source income. So continuing with this typical fact pattern, the U.S. and the foreign country tax the same item of income as their own. And guess what? Both countries have the right to do it. They have jurisdiction to tax the same item. So what is the main cause of international double taxation? It's these inconsistent sourcing rules in different countries that impose overlapping taxes. You have the US imposing taxes on the very same item of income that the Brazilian government, that the US person, is living in, is imposing their tax on that item of income. Of course, in that scenario, we're talking about income that was earned in Brazil. So if this were the norm, double taxation of this sort would stop international economic activity dead in its tracks. The US knows this, so how does it deal with this? Well, the US attempts to mitigate the harsh effects of worldwide taxation in 3 ways. Here you can see that I've listed them for you. The first is the foreign tax credit. It lies at the heart of the system of outbound US taxation. You have the foreign earned income exclusion. And finally, the Section 911 exclusion for personal service income of non-resident citizens and for non-resident citizens' housing costs. Now, I'm not going to do a deep dive into each one of these. I merely wanted to mention them so that you understand the ways that the US government has attempted to mitigate the effects of worldwide taxation. And I want you to focus just for now on the first one, the foreign tax credit. And here's why. When foreign tax rates are roughly the same as US tax rates, the combination of worldwide taxation and the foreign tax credit virtually eliminates double taxation entirely. So what I mean by that is if the US citizen is living abroad in a country where, say, the income tax rate is the same as the income tax rate that that taxpayer is paying in the US, the taxpayer is entitled to get a credit for the taxes that he's already paid to the foreign government. And essentially, as I said, if the income tax rates are the same, say it's a 35% income tax bracket, then the US taxpayer gets credit for the taxes, the 35% of taxes that he's paid to the foreign government. And that's the significance of the foreign tax credit. It eliminates the double taxation problem entirely because, as I said, the taxpayer does not have to pay taxes to the US government since he's paid taxes to the foreign government, and he's entitled to get a credit in the amount of the taxes that he paid to the foreign government. So right about now you might be asking yourself, what on God's green earth gives the United States the right to tax its citizens on a worldwide basis in the first place? Well, you wouldn't be the first person to have asked this question. The common misconception is that it's the Internal Revenue Code, but it's not, and nor is it legislation passed by Congress. Now, I will give you a hint. It's been codified in the Internal Revenue Code, but that only happened in the aftermath of a little-known Supreme Court case that breathed life into this concept of Worldwide Taxation. And what was that little known case? It's a case of Cook versus Tate. It was decided by the U.S. Supreme Court back in 1924. What's the traditional justification for U.S. worldwide taxation? Now, we could sit here and debate this issue from now until the end of eternity. There is quite simply no other issue that is as polarizing as this one in the U.S. international tax arena. It is certainly open. It has certainly been debated, vigorously over the years. I'm merely bringing this question up to give you the rationale of the Supreme Court justices in Cook v. Tate. They relied on the public benefits stemming from U.S. citizenship as providing justification for U.S. worldwide taxation. Tax scholars since then have interpreted the public benefits to include civil rights, political rights, and social rights. Now, no discussion of worldwide taxation would be complete unless we also addressed the other primary tax system, which I like to refer to as the sister system to worldwide taxation, and that is none other than territorial tax system. I want to make a very important point here before we go any further. There are two forms of worldwide taxation. So if you are a visual learner, as you see here, I've listed worldwide taxation and territorial tax system. But there would actually be, there are actually two subheadings that go under worldwide taxation. And that's a little teaser of what's to come, because I feel that in the spirit of being thorough and complete, that I do need to address both forms of worldwide taxation. But first, we're going to tackle territorial tax system. So, under a territorial tax system, taxation is limited to taxation of income or assets located inside a country's borders, no matter who derives it. It could be a citizen, a resident, or anyone else. Territorial tax systems are sometimes referred to as source-based taxation. And so how do they accommodate other tax systems? As you might recall, when we discussed worldwide taxation, we discussed the fact that we have overlapping tax systems from two jurisdictions that are essentially stepping on each other's feet. And that's what is the primary cause of international double trouble taxation. Well, in a territorial tax system, we don't have that problem. Why? Well, in the territorial tax system, a country accommodates another country's tax system in the simplest way possible, by not extending its own. Now we return to worldwide taxation. And as I mentioned to you before, there are two forms of worldwide taxation. To give you background, adequate background, so you will understand the genesis of the two forms of worldwide taxation, I have to cover this concept of political allegiance. Worldwide taxation is based on political allegiance. It's premised not on the source of income or assets. And so let me back up for a second. By political allegiance, what I'm referring to is that the worldwide taxation system is premised not on the source of income, but upon the political allegiance of the taxpayer who owns the income. That's what distinguishes worldwide taxation from a territorial tax system. Now, how a country defines the phrase political allegiance leads to two different types of worldwide taxation. The first is citizenship-based, where the United States is the poster child, and the second is residence-based, where Canada is the poster child. So let's start with citizenship-based worldwide taxation. Recall that what we're talking about here is the definition of political allegiance when it comes to worldwide taxation. And how a country defines political allegiance leads to one of two forms of worldwide taxation: citizenship-based or residence-based. So in a citizenship-based worldwide tax system, political allegiance is defined as an individual's citizenship, regardless of his residence. As I've mentioned, the U.S. is the poster child for citizenship-based worldwide taxation, and all we are saying here is that a U.S. citizen who lives abroad, perhaps in France, in the UK, in China, in Japan, Malaysia, that person is going to be taxed by the U.S. government on his worldwide income, meaning any domestic source income that he generated back in the United States and any foreign source income that was generated in the new country that he presently resides in. And so that's why political allegiance is defined as citizenship. It has nothing to do with where the person actually lives at the moment. The person could be living, like I said, halfway around the world and still have an obligation to report income from foreign sources. Now, residence-based defines political allegiance for tax purposes on the basis of residence. So you may be seeing now the distinction. It's very subtle, but it's critical for understanding the difference between these two tax systems. Once again, for citizenship-based worldwide taxation, political allegiance is defined as an individual's citizenship regardless of where he lives. But under residence-based worldwide taxation, political allegiance is defined on the basis of residence. So a country like Canada that practices a residence-based system taxes an individual's global income and holdings only if the individual resides in that nation. And so in keeping with the example of Canada, the Canadian government would tax an individual who resides in Canada, that person's global income, because they reside in Canada. All right, so once again, Canada imposes worldwide taxation on all of its residents without regard to Canadian citizenship. If you're from China or Japan or one of the Central European countries, and you're living in Canada and deriving income from sources in Canada, well, guess what? You're going to pay taxes to the Canadian government, regardless of the fact that you're not a Canadian citizen. And I tried to flesh this out a little bit more by giving you an even more concrete example for distinguishing citizenship-based taxation from residence-based taxation. A non-resident Canadian citizen. All right, let's stop for a second. By non-resident, I'm referring to an individual who is living anywhere in the world except Canada. yet he is a Canadian or she is a Canadian citizen. That person will pay Canadian income tax only on his Canadian source income. Okay, so if the Canadian citizen is living in Malaysia, is living in Malaysia and deriving Malaysian source income, the Canadian government will not tax him on his Malaysian source income. He's only liable for his Canadian source income. Any income that he may be continuing to generate even while he's living abroad in Malaysia. The U.S., on the other hand, will tax its citizens on both their domestic and foreign source income, even if they are living outside of the United States. Mainly if they're living in Europe or Asia, wherever, they're still going to tax their citizens on the foreign source income that is earned in that other country. And so that's the chief difference between the U.S. system of citizenship-based taxation and the Canadian system of residence-based taxation. Now for the moment that you've been all waiting for. Some history on the FBAR. Now let me tell you how I like to present material, just so you don't get frustrated. I like to start basic. And when I say basic, I mean I like to lay a solid foundation that we can then begin to build the cathedral or the house on top of. It's my feeling that if I assume too many things and I begin with building the second floor of this house without having given you the core concepts that are necessary, that that there's going to be more confusion later on, because just as in a basic algebra class, things in this area build on each other. And that's why I start basic, and with a basic foundation and a strong foundation, we're then able to tackle harder concepts. And we will understand those concepts and have a deeper appreciation for them because we have the foundation, meaning we know the formulas and we know how they work, and it's a matter of merely substituting numbers for variables. So that's why I start basic, and I then work my way up from there. What does FBAR stand for? None other than Foreign Bank Account Report. What is it about? What's its purpose? Well, the FBAR is a tool used by the U.S. government to identify people who may be using foreign financial accounts to break U.S. law. Information, now let me stop for a second. The FBAR, if you're not familiar with it, requests certain information. The key information that the FBAR requires is the name of the taxpayer social security number, the names of the banks where the taxpayer has foreign bank accounts, and the high watermark balance of the account in those foreign banks during the tax year. So if you had, say, 6 or 7 different foreign bank accounts in a given tax year, you would list each one of those bank accounts on the FBAR, assuming that the aggregate of them exceeded the $10,000 threshold, which we'll get to in a little bit. And so that gives you some context of the information that that I'm referring to in the second sentence here. Information contained on FBARs is used to identify or trace funds used for illegal purposes or to identify unreported income maintained or generated abroad. Now, if I were to poll those who are on this webinar and ask, what breathed life into the FBAR? What is the origin of the FBAR? I'd venture to guess that most people would say that it's a creature of the Internal Revenue Service, that it may have come out of the Internal Revenue Code. But believe it or not, it didn't. It's actually a creature of the Bank Secrecy Act and not the Internal Revenue Code. Now, the Bank Secrecy Act was passed back in the 70s. So believe it or not, the FBAR has been on the books for decades. Now, the Bank Secrecy Act gives the Department of Treasury the authority to collect information from U.S. persons who have financial interests in or signature authority over financial accounts maintained at foreign banks. Today, the IRS has breathed new life into the FBAR as a tax enforcement and revenue-raising tool. And isn't it interesting that the IRS had really began enforcing the FBAR with a great deal of tenacity in the wake of 9/11/2001, because as you can see here, the IRS has been administering it and enforcing it since 2003. But the interesting question here is how come it wasn't being administered and enforced for the decades prior to 2003? Because as I said, it was a part of the Bank Secrecy Act, and the Bank Secrecy Act was passed in the 70s. So you can definitely see that there is some correlation to 9/11/2001, since the IRS really began their enforcement of the FBAR in 2003. And as you can imagine, the U.S. government became privy to many things and learned that terrorist groups such as Al-Qaeda were using the traditional banking system to fund a lot of their activities. So that was one of the reasons for the FBAR, the FBAR being enforced as vigorously as it was in the years in the aftermath of 2001. The other reason, of course, is that the Department of Treasury realized that there were billions of dollars of unreported income that U.S. citizens and residents had parked overseas in foreign bank accounts. The rule. Now, you can see here that certain parts of this rule have been italicized, and those are going to be the elements that I spoke to you about earlier that we're going to do a deep dive on and explore in more detail. So this rule can be stated in a lengthy compound sentence as the following. A U.S. person must file an FBAR if that person has a financial interest in or signature authority over any financial account outside of the U.S. and the aggregate maximum value of the account exceeds $10,000 at any time during the calendar year. Boy, it's hard to recite that without taking a breath, but if you read it a second time, it might sound as if you understand it, and that it's not all that bad. And that is what leads to a lot of confusion, because the terms that you see here that have been italicized don't necessarily have the same meaning that you and I would put to them, in our daily lives. They're not household terms because their definitions have very precise meanings. And so here are the elements that I've identified as being the critical elements of the FBAR rule. The first is U.S. person. The second is financial interest in or signature authority over. The third is any financial account outside of the U.S. 4, aggregate maximum value of accounts. 5, exceeds $10,000. And by the way, USD is just, it just stands for United States currency. 6, at any time during the calendar year. Once again, these are legal terms of art with precise meanings. No matter how familiar they might sound, they cannot be interpreted according to the everyday meaning that you and I give to them. They are not household appliances. Deconstructing the rule. And we're going to take these one at a time in the same order that I listed them in the last slide. U.S. person. So who is a U.S. person? Well, when I think of a U.S. person, probably point number 1 is the first thing that comes to mind. A citizen or resident of the U.S. So I think that we're probably all on the same page about that one. But take a look at the second one. An entity. An entity created or organized in the U.S. or under the laws of the U.S. Would you have expected the term U.S. person to include more than just a human being, with a heartbeat and a pulse that walks upright? I, for one, wouldn't. And the fact that it includes an entity is certainly an eye-opener, but it does. So let's make sure that we understand how these terms are being interpreted and what their definitions are, okay? Because they're not limited to what our impressions are of them. So again, the U.S. person includes an entity created or organized in the U.S. or under the laws of the U.S. By entity, we're not just referring to corporations, but we're also referring to partnerships and limited liability companies. We're also referring to a trust formed under the laws of the U.S., as well as an estate formed under the laws of the U.S. How about U.S. resident? What is the test for determining whether a person is a U.S. resident? Well, we're lucky here. We have some guidance from the IRS, and it states very simply that we are to apply the residency test from Section 7701B of the United States Code to determine if the filer is a resident of the U.S. And here are 2 examples. In example 1, we have Matt. Matt's a citizen of Argentina. He's lived in the U.S. every day for the last 3 years. Because Matt is considered a resident by virtue of the rules under 7701B, he must file an FBAR. Again, it's the rules under United States Code 7701B that have to be satisfied. And if they are satisfied, then the filer is automatically deemed to be a resident of the U.S. In our second example, we have Kyle. Kyle is a permanent resident of the U.S., but he's also a citizen of the U.K. Now, as many of you know, the US and the UK have a tax treaty. Under the tax treaty, Kyle is a tax resident of the UK, and he elects to be taxed as a resident of the UK. He must still file an FBAR. Why? Well, tax treaties with the US do not affect FBAR filing obligations. Moving on to the second element of this rule, financial account. What does a financial account include? And in the same way that we were able to identify a U.S. citizen and a U.S. resident as being the two types of people that the IRS is referring to when it says U.S. person, we can probably assume that a run-of-the-mill bank account, like a savings account, a checking account, and a time deposit account, are included, or is what's meant by a financial account, and that would be true. So a bank account, such as savings accounts, checking accounts, and time deposits, do fall under the category of a financial account. How about other accounts, though? How about securities accounts? Yup, they're included too. By securities accounts, we're referring to brokerage accounts and securities derivatives and financial instruments accounts. We're also referring to commodity futures or options accounts. How about insurance policies with a cash value? Yup, they're included too. Mutual funds or similar pooled funds, they're included too. But online poker accounts, could those actually be included as a financial account? Well, thanks to some recent case law, they are in fact included as a financial account under the FBAR rule. And in the last category, we might consider this to be the catch-all category. And the catch-all category is any other account maintained in a foreign financial institution or with a person performing the services of a financial institution. What might be an example of that? Well, how about a scenario where a person has stored gold or currency cash notes in a vault that's located inside a foreign bank? That would be an example of the type of account that is embodied in this catch-all of any other accounts. So what do we get from this definition of financial account? What we get is that financial account is very broad and includes virtually every type of bank account that's out there. Now, there are gray areas and there are exceptions to financial account, and we're going to cover some of the most common exceptions in this next slide. What I've done here is I've tried to itemize for you the main exceptions to financial account. These are the ones that tend to come up most frequently. The first has to do with IRA owners and beneficiaries. Owners or beneficiaries of IRAs are not required to report a foreign financial account held in the IRA. The second exception to a financial account are participants in and beneficiaries of tax-qualified retirement plans. Now, this is not as straightforward as you might think. And the reason why is because you have to do a little bit of digging to find out if the taxpayer is in fact a participant in or a beneficiary of the type of retirement plan that the IRS contemplates by this exception. And as you can see here, that the type of retirement plan that the IRS is specifically referring to, and that the taxpayer has to be a participant in or beneficiary of, is one that's described in Internal Revenue Code section 401A, 403A, or 403B. So please, please, please don't lump every taxpayer into one category and say that and automatically assume that there is no FBAR reporting obligation. First, do your due diligence and take a look at Internal Revenue Code 401A, 403A, and 403B, and make sure that the taxpayer, that the retirement plan that the taxpayer is a participant in or a beneficiary in closely matches that described in one of these revenue code sections. Because only if that is true will the taxpayer be exempted from having to file an FBAR. Consolidated FBAR. A U.S. person that is an entity and is named in a consolidated FBAR filed by a greater than 50% owner is not required to file a separate FBAR. Trust beneficiaries. A trust beneficiary with a direct or indirect financial interest in greater than 50% of the trust assets or income is not required to report the trust's foreign financial accounts on an FBAR. However, the trustee of the trust or the agent of the trust must be a U.S. person and must have filed an FBAR disclosing the trust's foreign financial accounts. So there is a condition that's attached to this, and that is that the trustee of the trust, or the agent of the trust must A, be a U.S. person, and must B, have filed an FBAR disclosing the trust's foreign financial accounts. Then and only then will a trust beneficiary that has a financial interest in more than 50% of the trust assets not have to report the trust assets on a separate FBAR. Signature authority. Individuals who have signature authority over but no financial interest in a foreign financial account are not required to report the account in certain situations. Okay, and I would caution you to be careful here, because signature authority, as you may recall, was mentioned as one of the triggers for having an FBAR filing obligation. But there are specific situations that have been carved out for those with signature authority over foreign financial accounts. And those special exceptions would allow the taxpayer to not have to report the account. But again, this is a very narrow exception and is limited to certain situations. Here is a gray area that has come up quite frequently in the last couple of years. Remember how we talked a little earlier about gold or cash notes stored in a vault in a foreign financial institution? Well, the IRS does consider the does consider that to be an account. But we have a subtle distinction here in this hypothetical. In this hypothetical, although the gold is stored inside a vault at the foreign bank, we've now added a new fact. The vault is actually leased to a private company. So in other words, there's a private company that is the lessee, or the entity that is leasing the vault, and therefore holding the gold or cash notes on behalf of the taxpayer. And so the question then becomes, does a taxpayer have an FBAR reporting requirement? Does the taxpayer have to treat the gold that's stored in that private vault as a foreign financial bank account and file an FBAR, an accompanying FBAR? Again, this is an issue that is, in my opinion, one of first impression. I've done a lot of digging into this issue and have not found any revenue rulings or any court rulings that are directly on point. So that's why I've classified it as a gray area. I'm sorry that I can't give you more certainty on this issue. But my disclaimer here is that it would be best to consult with a tax attorney, because there are strong arguments that can be made both in favor and against. When is a financial account a foreign financial account? This might be one of the easiest elements of deconstructing the rule. It's very simply when the account is located outside of the U.S. Now, the U.S. includes all 50 states and the District of Columbia, as well as all U.S. territories and possessions. So we have now come to the end of our first module. I encourage you to send me emails if you have any questions on the information that's already been covered in the first part. You have my contact information, including my telephone number and my email. Please, I encourage you to view the remaining webinars in the series, as they are chock full of information that is specifically designed to help you navigate these choppy seas of foreign asset reporting. And so I look forward to seeing you in Module 2, where we will pick up where we left off and finish going over the last few elements of the FBAR rule.